So market got a little bit rocky today. You saw the S&P fall a little bit more than 1%. NASDAQ down about 1.8 on the 100. Some interesting things going on right here from a technical perspective that I wanted to talk about, but then really more importantly, I wanted to talk about more from a spread perspective, probably something that you don't really see very much of, but I feel like it's important to review it. I had noted that it looked like it was coming to a completion. You have a clear, five-wave structure here, A, B, C, D, E. You have the 3 touches along the top, 2 touches along the bottom. You're now getting a 3rd touch. This is part of the completion. And essentially what that would suggest is that we really should, as I noted last night, if this was the ultimate and final high, we should see a pretty sharp decline. And we pretty much have gotten that at this point. In fact, we basically erased all the gains of Monday and Tuesday between today and this evening's trading. And so, what we're looking for, at least from this perspective, if this were to continue, would be a decline where we undercut this trend line and then a further drop undercutting this low at 55.60. The other thing that I thought was worth taking a look at today was that the 200-day moving average for the S&P 500 futures, at least, way up here, never really got close to it. But on the cash market, you can see we actually managed to close back below it. And so I just thought that was an interesting piece to note from a technical perspective. But again, when you look at it from a technical sense, the pattern just seems to suggest that we're probably still having some further to go. In the NASDAQ, also very similar. We got close to the 200-day moving average. That was rejected. Again, when we look at it a little bit on a more closer basis, it has more of a look of a megaphone pattern than it does a flag. But again, you could still count this out pretty easily in terms of the same thing. And again, it would suggest that we undercut this low and eventually, take out the lows that were established here on March 11th. When you look at the futures, sort of the same thing that we're seeing here. So ultimately speaking, what you're seeing in the indices is actually repeated across several different other asset classes, and I found that to be really interesting. This is the CDX high yield credit spread index. Here you can see we broke this downtrend. We've now come up, broke this level of resistance, came here, broke this level of resistance. We came back and tested it, and now we're moving higher. Also, when we look at this, it almost looks like we have the makings also of a bull flag here, at least from a perspective of the credit spread. And this would suggest that maybe we're looking at a scenario here where we could be about to see, credit spreads really start moving sharply higher from where they are currently. And basically, when you think about credit spreads and them widening, it's really more of a form when you think about it and translate it into the S&P 500, so to speak. You're really talking more about a multiple contraction phase for the broader market. In fact, it could suggest we see the credit spread move all the way up to somewhere 410 basis points, which would be really up at this area of resistance. And that would be a pretty meaningful retracement. In fact, it would basically take us back to where we were in mid-November of 2023, erasing a big bulk of the gains that we've seen thus far. Now, obviously, this was October of 23. That was that low that we saw. And if we kind of equate that to where the S&P 500 was during that period of time, it was obviously much, much lower. Here's your, November of 23 phase. You were somewhere around 4,500. Now, I'm not saying we're going all the way back there, but if you think about it from a credit spread perspective, and, again, here's your, if you were to extrapolate this entire move, it takes you back to around 5,040. But really, what I'm trying to note here is that from a credit spread perspective, it would take us back to a PE multiple that is probably significantly lower than where it is today. And that's not obviously including if there's any form of earnings contraction as well. So this is something really to keep a very close eye on. The other thing that I'm noticing, at least, is this is we talk about this every once in a while. This is the 5-year US dollar Japanese yen cross currency basis swap spread. And what's really important about this spread is that it also has a very similar sort of movement to what you see in high yield credit spreads here in the US. In fact, if I take this symbol and I apply it to this chart, what you see, it doesn't, at least when you look at it on the onset, you don't really necessarily see, but you can clearly get a sense that these two spreads actually move very close together. Now, we're not looking at this in terms of we're looking at this inverted here, and so you're not seeing it in terms of these values. You're looking at it more on a price metric. And again, what you see here is that these spreads tend to move together. And so if this is going to start, also, if we're going to see these spreads really start coming down, we should also start seeing these coming down. And sometimes this can act a little bit as a leading indicator to where spreads are going overall. So this is something to really keep a watch on if you can. The other thing, obviously, is that rates in Japan continue to move higher. In fact, they're a little bit higher again tonight. And this is also one reason why you're seeing some of these movements and some of these spreads, especially when it comes to the Japanese basis swap spread. And it's not really just in the Japanese. You're seeing it really across multiple different swap spreads. Here's your Euro basis swap spread. That's been showing signs of contraction and coming in a little bit. So this is occurring in across multiple different type of spreads. And these are important. Here's your 10-year Treasury swap spread, also showing signs of coming in after moving briefly higher. And so I think what this is broadly a sign of is really more, I think, a sign of liquidity starting to get a little bit tighter in markets. And again, there's a good reason for that. We're going into quarter end, and we know typically into quarter end balance sheets at banks usually get tightened up. And that usually results in less liquidity in the overall market. And when we look at the one thing you can watch every day to get a sense of it, you can watch the reverse repo facility. That was up today to around 241 billion. And I would expect that going into March 31st, you're going to continue to see this increase. And what ultimately this is going to do, again, is sort of give you a sense of whether or not liquidity is being, sucked out of the market. And also, obviously, you can watch the secured overnight financing rate, because if this keeps going higher, that's also going to be an indication of liquidity getting sucked out of the market. So right now, what we're kind of looking at is, obviously, there's a lot of headline risk because of what's going on with, tariffs and the trade war and all that other stuff. But I think a lot of also what we're seeing is somewhat mechanical from a standpoint of it's going in the quarter end. I think you have a lot of risk in terms of, liquidity just being, sort of drained out of the market as that happens. Now that should eventually begin to ease as we go into the beginning of April. But then we're also going to get into a scenario where tax receipts are due on April 15th, and that's also going to suck liquidity out of the market in a pretty big way. In fact, if you just go back and look the last couple of years in April, it's been a really not a very smooth period of time. If we go back to March of 23, obviously not a great period of time. That was SVB. And then you can see a lot of chop basically between that April tax deadline in 23. If we go back to 24, actually had a pretty sizable correction. Here's April 1st into April 19th. This was a pretty decent move. You can see we were down about 6%. And if you go back to April of 22 was actually a pretty rough period of time as well. Here you peaked on April 1st. And, if you go through, tax season, April 15th, you're talking about another 5% decline just for that. Then obviously we continued to move lower because there was other things going on in the market at that point. So, if you were to see a similar sort of 5 to 6% move due to tax selling, due to tax payments coming out, you're talking about, if we were to break from here, you're talking about going down, immediately to around 5,400. So those are some other things to kind of keep in mind in terms of liquidity. Obviously, this isn't including the other pieces of the market that are going on, such as rising uncertainty, rising recession risk, rising chances of earnings estimates coming down. And so we know that earnings estimates have been coming down already. And so even though, the market's been coming down, you're not really seeing it get a whole lot cheaper just because earnings estimates have been coming down. And as earnings estimates come down, the market has to go down even more for the valuation to make, more sense. And you can see that we've already gone from around, call it $275 per share in June down to $265 per share, which is about a $10 decline, call it, 3-ish%, 4-ish% overall. And, that in itself means that stocks have to go down, to sort of make up for that if you're going to see this PE multiple continue to contract as sort of credit spreads are indicating. Obviously, we're watching what's happening in Japan. We're watching what's happening in South Korea as well. Obviously the DAX has been having a really good go, but it's starting to show some signs of stalling out. You're also seeing surging, copper prices, which are pushing up inflation expectations. So there's just a whole lot of things going on in this marketplace right now. We've started to even see oil moving higher again. So there's a lot of moving parts here, and that's not even including the fact that you have a pretty important inflation report going on Friday, where, it seems like estimates are for around a 0.3% number, but we're seeing Kalshi betting markets still at 0.4. So I think you just have to be really aware of some of the really big things that are happening just the rest of this week, on top of all the other things that we typically kind of think about. So hope you enjoyed this. Please have a great rest of your night, and we'll see you again soon. Bye.